All right, welcome everyone. Today, we are completely decoding a massive, dense, and, let's be honest, often super misunderstood world. We're talking about auto insurance. And in this explainer, we're actually going to look at it like an iceberg, right? We all easily see the surface stuff, the premiums we pay, those basic coverages the law says we literally have to have. But just beneath that surface, there is this vast, completely hidden landscape of really complex claims, sneaky traps, and invisible financial losses that the insurance industry, well, they don't exactly advertise them. So we're going deep today to empower you with the exact knowledge you need to actually protect your assets. But before we get into all that, I want you to just picture this scenario for a second. Imagine you're in a wreck. Totally not your fault. You take your car to literally the best body shop in town. They use actual factory parts, the paint match is absolutely flawless, and when you pick it up, it looks perfect. Here's the question. Is that car still worth the exact same amount of money as it was the second before that crash? Now, most people instinctively say, well, yeah, of course, because it's fixed. But as you'll see a bit later in this explainer, that assumption is actually dead wrong, and honestly, it could be costing you thousands of dollars. Okay, let's dive right into this. Here is our roadmap for today. First, auto insurance building blocks. Second, decoding your premium costs. Third, accidents, claims, and traps. And finally, the diminished value secret. Starting things off with Section 1, auto insurance building blocks, these surface level. So we all know we buy insurance to comply with state laws, right? Or to satisfy our auto lenders, and obviously to protect our own stuff. But you might be wondering, who actually protects us from the insurers? Well, the authoritative source for a lot of this foundational info is the NAIC. That's the National Association of Insurance Commissioners. They're basically the oldest association of state government officials made up of the chief insurance regulators from all 50 states. And their primary mission is literally to protect you, the consumer. They're the ones helping to set the standards and all those best practices that actually shape the policies you and I buy every single day. Now, to really navigate this world, we kind of need to speak the language. And an absolutely crucial concept, depending entirely on where you live, is what's called a no-fault state. Basically, if you live in a no-fault state, your own insurance company pays for your personal injuries and the injuries of your passengers, completely regardless of who actually caused the accident. This usually gets paid out under something called PIP, or personal injury protection. But, and hey, this is a really big but, you still have to file a claim with the at-fault driver's insurance to get paid for the physical damage to your car. So an easy way to remember it, no fault generally applies to bodies, not bumpers. All right, looking beyond PIP, your policy is built from a few distinct coverages, and they're almost always priced separately. You've got bodily injury and property damage liability. Those cover the damage you might accidentally cause to other people and their stuff. Then uninsured motorist protects you from those drivers out there who have zero insurance. Finally, you have collision, which pays for damage to your car if you hit something, and comprehensive, which is basically for almost everything else. Theft, a massive hailstorm, floods, or, I don't know, a deer jumping right out into the road. Moving right along to Section 2, decoding your premium costs, or what you actually pay. Let's be real, coverage definitely isn't free. But how do insurers actually calculate that specific dollar amount they charge you every 6 months? Well, they use a massive variety of factors to rate your personal risk. Your driving record? Obviously. But did you know most insurers actually use a credit-based insurance score? Yeah, studies apparently show a correlation between that score and the likelihood of you filing a claim. They also look at your demographics, age, gender, marital status. They factor in whether you drive a super sensible sedan or a high-performance sports car, and whether you live in a dense urban area prone to theft or just a quiet rural town. They even pull what's known as a CLUE report, which is this nationwide database of your prior claims. All of that data gets crunched together to spit out your final premium. You do have one major lever to control that premium, though, and that's your deductible. Simply put, this is the out-of-pocket amount you agree to pay on a claim before the insurance company steps in to cover the rest. Choosing a higher deductible, let's say $1,000 instead of $500, is actually a really strategic way to lower your monthly premium. You're basically taking on more of the immediate risk yourself, so the insurer charges you less upfront. Section 3, accidents, claims, and traps. We are heading below the surface now. So you faithfully paid your premiums, and then, boom, the worst happens. You hear that crunch of metal. The moments right after an accident are always incredibly chaotic. But listen, your actions right here absolutely dictate the success of your future claim. If anyone is injured, call 911 immediately. If the car is drivable, get it the heck out of traffic. Then you need to strictly stick to gathering evidence. Exchange names, addresses, and pull insurance details straight from the other driver's proof of insurance card. Take tons of photos of the scene, the cars, the license plates, and definitely make exact notes on the weather and road conditions. This evidence, it is literally your armor when the claims adjusters start getting involved. Now, while you are busy gathering all that evidence, you really need to be extremely careful about what evidence you might be handing over to the other side. Which brings us to a huge modern trap. Could a simple status update on your phone actually ruin your entire insurance claim? The short answer? Absolutely, yes, for sure. Legal experts, like the folks over at Madrid Law, issue some really strong warnings about this. Insurance companies and their lawyers will literally scour your social media profiles. If you're claiming a severe back injury, but your public profile shows you out dancing with friends, or posting that you feel blessed and totally fine just hours after the wreck, they will absolutely use your own post to invalidate or severely diminish your personal injury claim. So rule of thumb, when in doubt, stay entirely off social media while a claim is active. And honestly, this brilliantly illustrates how insurers look for absolutely every legal avenue to limit their payouts. And that perfectly tees up Section 4, the diminished value secret, the really deep water. All right, we are now in the absolute deepest waters of the auto insurance iceberg. Remember that question I asked you at the very beginning? Even after a completely flawless repair, your car has suffered something called inherent diminished value, which is also known in the industry as stigma damage. It's basically the residual loss of market value simply because the vehicle now has an accident history. Think about it. If you're walking onto a used car lot and you see two identical cars for the exact same price, but the dealer tells you one was in a major crash and perfectly repaired, which one do you buy? You buy the one with zero crash history, right? To get you to actually buy the crashed one, they would have to slash the price. Well, that price drop, that is exactly the diminished value you suffer as an owner. So the crucial point here is figuring out who is legally obligated to pay you for that invisible loss. And that depends entirely on who you are filing the claim with. A first-party claim is when you file with your own insurance company, and that's usually governed strictly by the contract language inside your specific policy. A third-party claim, on the other hand, is when you file against the at-fault driver's insurance, which is actually governed by tort law. Historically, insurers fought this tooth and nail. They argued that their only duty was to repair the physical damage on first-party claims, nothing more. But then, in 2001, the Georgia Supreme Court dropped an absolute bomb on the industry in a landmark case called State Farm v. Mabry. The court actually ruled that the word loss in the insurance contract inherently included this reputational loss in value. State Farm was ordered to pay out $150 million and evaluate all first-party physical damage claims for diminished value across the entire state of Georgia. So, how do they actually calculate this invisible stigma? Well, they developed what's known as the 17C formula. Let's break it down. It starts by capping the maximum possible loss at 10% of the vehicle's retail value. Then they apply a damage modifier, which is just a multiplier based on how severely the car was hit. And finally, they apply a mileage modifier, which reduces the payout if the car has a lot of miles on it. To put that into perspective, let's say your car's worth $16,000. The base loss cap is 10%, so that's $1,600. Multiply that by a 0.5 moderate damage modifier and a 0.6 mileage modifier, and boom, they'll offer you $480 for diminished value. Now, a lot of critics argue this formula arbitrarily double penalizes drivers for mileage, but it still remains a super widely used baseline for negotiations today. Now, while first-party claims for diminished value are heavily restricted in most states, third-party claims, again, when someone else hits you, are much more widely recognized under tort law. States like Arizona, Florida, Texas, and New York, along with several others you can see here, actually allow you to pursue the at-fault driver for the diminished value of your vehicle. The burden is definitely on you to prove it, which often requires hiring expert appraisers, but the legal precedent exists to make you fully financially whole again. Okay, we've covered the absolute basics of compliance, the harsh reality of how premiums are calculated, the completely unexpected traps of social media, and those hidden depths of stigma damage. So here's my final thought for you. The next time a body shop hands you the keys and tells you your car is good as new, I really want you to ask yourself, is it really? Or are you just paying the invisible price of stigma right out of your own pocket? Knowing your rights, understanding your policy language, and knowing your local state laws, that is quite literally the only way to navigate the auto insurance iceberg without sinking. Thanks so much for joining me on this explainer, and hey, stay focused out there.